Good morning, and welcome to TOITOI Japan Market Radio for February 25, 2026. I'm your host here in Tokyo, bringing you the latest from Japanese markets for global investors tracking their Japan exposure. Let's dive straight into today's session.
Thanks for having me. Today we saw strong gains across Japanese equities, with the Nikkei 225 closing at 58,583.121. Up 2.202%. TOPIX rose 0.848% to 4,045.0, while the Mothers Index dipped slightly by 0.129% to 2317.0. Japanese real estate investment trusts also moved higher, with the J-REIT Index up 0.584% to 2065.5. In currency markets, dollar-yen climbed 1.335% to 156.699, and in commodities, gold in yen terms gained 0.735% to 19,175.0, while crude oil rose 0.747% to 66.12.
Quite a rally in the Nikkei today. Let's get into the details behind these moves. The headline grabbing everyone's attention is that the Nikkei 225 has hit a fresh record high. This marks another milestone in what has been a sustained upward trend for Japanese equities. Walk us through what's driving this and why it matters for Japan specifically.
The record closing is significant for several reasons. First, it reflects strengthened corporate profitability and growing investor confidence in Japanese equities overall. We're also seeing potential validation of structural reforms that have improved competitiveness in the domestic market. From a macro perspective, these wealth effects could support consumer spending and broader economic activity going forward. Importantly, this rally is enhancing the appeal of Japanese equities to both domestic and international investors, which creates a virtuous cycle of inflows.
And what are the implications across asset classes? How should global investors be thinking about equities, currency, and yields in this context?
For equities, the record high signals continued strength, and we're seeing broader participation with TOPIX also gaining ground today. Momentum like this tends to attract further inflows, especially if fundamentals remain supportive. On the currency side, record equity highs could actually support modest yen appreciation as international investors need to convert into yen to access Japanese stocks. However, the magnitude really depends on what the Bank of Japan signals and broader global risk sentiment. For Japanese government bond yields, rising equities and stronger economic sentiment typically put upward pressure on 10-year JGB yields as investors rotate into risk assets. We may also see expectations of eventual BOJ tightening strengthen, though that relationship is complex and depends heavily on inflation dynamics.
On the policy side, we're seeing some very interesting developments at the Bank of Japan. Reports indicate that Kazuo Takaichi's recent appointments to the BOJ's decision-making body are pushing up long-term bond yields. These picks reflect a more reflationist policy orientation. This feels like a significant shift.
It absolutely is. Takaichi is known as an inflation hawk advocate, which suggests the BOJ may be moving away from the ultra-loose stance that has persisted for decades. Rising long-term yields signal that markets are expecting higher interest rates and potentially tighter monetary conditions ahead. This represents a real policy inflection point after years of aggressive easing and JGB yield suppression. The shift could affect borrowing costs across Japan's economy and significantly influence inflation expectations.
So what does this mean practically for the three key areas: yields, currency, and equities?
For JGB yields, we should expect them to keep rising, particularly the 10-year benchmark. Yield curve control may face further pressure or require adjustment upward. The yen is likely to strengthen because higher yield differentials relative to other major currencies make yen-denominated assets more attractive to global investors. For equities, the outlook is mixed. Financial stocks may benefit from wider lending spreads, which is positive for banks and insurers. However, rate-sensitive sectors like utilities and REITs could face headwinds, and highly leveraged companies will feel pressure from rising borrowing costs. The key risk here is that rapid yield rises could destabilize equity valuations and stress heavily indebted corporates or households.
That's an important nuance for portfolio managers to watch. Shifting back to equities, there's another driver in play today beyond domestic factors. Global markets rallied on renewed artificial intelligence enthusiasm, and both the Kospi and Nikkei posted notable gains. This broader rally encompassed major indices globally. How significant is Japan's participation in this AI-driven rally?
Japan's outperformance here is quite significant. Japanese equities, particularly the Nikkei, benefit heavily from global tech and semiconductor momentum. Think about names like Sony, Advantest, and Tokyo Electron. These are core holdings that rally when AI infrastructure spending accelerates. The AI frenzy typically supports Japan's robotics and semiconductor equipment manufacturers, which are crucial suppliers to the global AI infrastructure build-out. Additionally, a risk-on sentiment shift like this favors Japanese exporters and reduces safe haven demand pressures on the yen. We're also seeing institutional investors rotate into Japanese tech and innovation-exposed names alongside other Asia-Pacific plays.
And what about the knock-on effects for currency and yields in this scenario?
For equities, the near-term tailwind is clearly positive. Tech-heavy sectors are likely outperforming, and continued AI enthusiasm could sustain momentum, particularly in semiconductor equipment and robotics subsectors. On the currency side, the yen is likely to weaken modestly as risk-on sentiment reduces demand for yen as a safe haven. Higher global yields may also pressure the yen somewhat. For JGB yields, there's potential upward pressure if the rally extends and risk appetite remains elevated, which would reduce traditional JGB buying demand. That said, BOJ policy remains the primary driver of yield movements overall. Investors should monitor whether the AI enthusiasm translates into broader capital expenditure cycles that would benefit Japanese supply chains more structurally.
It sounds like there's a tension between domestic policy shifts pushing yields higher and global risk appetite that could weaken the yen. How should global investors think about positioning in this environment?
That's exactly right. There are crosscurrents at play. The domestic policy shift toward less accommodation is a structural change that suggests higher yields and a stronger yen over time. But in the near term, global risk-on flows and AI enthusiasm create offsetting forces, particularly on the currency. For global investors with Japan exposure, the key is to think about sector positioning within equities. Financials look attractive given rising yields, while exporters benefit if the yen doesn't strengthen too quickly. But you want to be cautious on highly leveraged domestic plays and rate-sensitive sectors if yields continue climbing. On the currency side, this isn't a one-way trade. Volatility is likely as markets digest BOJ policy signals against global risk sentiment.
Let's tie this together for our global audience. We've seen a record high in the Nikkei, significant policy shifts at the BOJ pushing up long-term yields, and global AI enthusiasm driving tech-heavy indices higher. What are the main themes investors should be focused on as we move forward?
The main theme is transition. Japan is transitioning from decades of ultra-loose policy towards something more normalized, and that has profound implications for every asset class. Rising yields mean borrowing costs are going up, which benefits some sectors and hurts others. The yen's direction will depend on the balance between domestic tightening and global risk appetite. And equities are being supported by both domestic strength and global tech enthusiasm, but selectivity matters more than ever. Global investors need to be dynamic in their Japan allocations, focusing on sectors that benefit from this transition rather than taking broad-based exposure.
Excellent summary. For those of you tracking Japanese markets, today's session underscores how interconnected domestic policy, global risk sentiment, and sector dynamics have become. If you follow Japan's markets closely, consider subscribing to stay updated on these evolving themes. Thanks for joining us on TOITOI Japan Market Radio. We'll be back tomorrow with another briefing for global investors.
Thank you.